Hello sector watchers, welcome to the show. This is the 109th episode of Sector Spotlight for Tuesday the 4th of January 2022, and I'm recording it on Monday as usual. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Happy New Year, and I really hope that you had a good transition, a great New Year's Eve, a great holiday period. Spent some time with your family, did all the things that we need to do during the holiday period, and that you had a good time and you're refreshed and charged to go again into the new year. And of course, everybody makes New Year's resolutions, and so do I. I try that every year. And with regard to RRG, to the RRG blog, to Sector Spotlight, I thought, back about the stuff that we did and that we've been doing, and I don't think it's broken. If it's not broken, don't fix it. But there's always room for improvement. And I wrote a Chart Watchers article on a few things that I want to work on going into the new year, and this is the article that I wrote. It's the last article of 2021 for me. Probably you read it in 2022 first, because that was when the newsletter was published and most people get it into their email box. But a few things that I thought about doing is that maybe I could bring a little bit more structure into the shows. Have set segments, because we do have a few segments like seasonality and monthly charts that we do on set moments. We have the review, but then there is a lot of other things that I do from time to time, but sometimes it's once every 2 weeks, and then I don't do it for 2 months, and so I think that I can improve a little bit there. So I'm working on a set of segments that I can stick into the show, and then in the announcement I can tell you, so we're going to deal with these segments today. So for today, these segments are seasonality for January and the monthly charts that have finished in December. Usually we do that on the last and the first Tuesday. We had no shows at the end of the year, so I'm going to combine those into this show after obviously a very short look back on what happened over the last 2 weeks. But it was the holiday period and not much happened. Again, if you've got anything to say, anything to share with me, please use any of the handles on the screen. I had one idea that I wanted to finish all my emails before the end of the year. I did a lot. A lot of you should have received replies to your emails, but I didn't finish. I didn't find the complete bottom of my inbox, so I still have a few to go, a couple of dozens to go, and they are there. They will come. Just be patient. Anyway, enough for now. Let's start with a quick look back, and then we're going to take a look at monthly charts, and then we're going to take a look at seasonality for January. Ladies and gentlemen, thank you for watching again. This is Sector Spotlight. Let's start with a quick look on asset class rotation as it played out. And I've loaded up 12 trading days, because that was the last Sector Spotlight show that we did. So it's a little bit more than, well, it's like 2 weeks of trading. And if we look at the table, you can see that the real estate sector did really, really well at the end of the year. And so did both commodity indexes, and then SPY followed. So this is another change that I'm making from this show onward. We always had ITOT, the total stock market index there. That's really not an index that a lot of people are watching. And if you look at the correlation between SPY and ITOT, it's about 100 or 1, no matter how you look at it. So I decided to just switch back to SPY as we used in the beginning, because in the end of the day, we're always talking about SPY. We're always looking at the SPY chart anyway. So as a matter of convenience and to appeal to everybody, when I talk about the stock market, I'm talking about SPY or the S&P 500. And we can always, dive into other segments of the market when it's appropriate. But for this high-level asset class overview, I'm planning to use SPY as the proxy for the stock market in the US. Again, over the last 12 days, 2.9% gain for SPY, so that's good. More than 1% over the benchmark VBINX. And the government bonds actually gained 0.5%, which is lower than the benchmark, but still up. And if we look at the daily rotations, then obviously we see real estate hooking back up here, and so does SPY. We had this little rollover and we're now picking up again. That's today's price action. And if we move that to the left-hand side of the chart where we have the weekly rotations, then we see that both SPY and real estate V&Q are inside the leading quadrant, moving up into that leading quadrant, which is good. And you see the long tails for commodities still moving lower, going through that correction. And I think we need a little bit more of a correction because this is continuing to be a long tail pointing towards the lagging quadrant. And you see that the rally, the momentum rally that we had over the last 2 weeks is already starting to level off. That gain on the momentum scale is not very persistent, and it looks as if it's rolling over. So it looks as if commodities on the longer term picture still need a little bit more time to correct. Remember, the long-term picture, we're going to look at some monthly charts later on, still pretty good. They look to be in a long-term turnaround. For the fixed income, we see a bit of a cluster here for government bonds and high yield and corporate bonds. They're still on the left-hand side while stocks are still on the right-hand side. So the message here from an RRG point of view is still a pretty clear preference for stocks over bonds, and that will fluctuate over time. But as long as SPY is comfortably inside the leading quadrant, or at least on the right-hand side of the RRG graph, and government bond and to a lesser extent high yield and corporates are on the left-hand side and inside lagging, then I think that we can safely say and go with the trend that stocks are outperforming bonds. So that's it for asset classes right now. We're going to do the same. A quick look back for US sectors now. When we move to sectors, and on the right-hand side, I have the same 12 trading days as we did for the asset classes. And what we can see here is a pretty good 12 days, half a month for energy, consumer discretionary, real estate. We already saw that in the asset class division. And then we go to material staples, and then we go, SPY was 1.9, so this is already, communication services and financials more or less in line with the index. Same for healthcare. And then the real underperformance were industrials, technology, and utilities. I would say this is a pretty clear rotation shorter term that is going into a correction for real estate, healthcare, staples, utilities. And technology is actually picking up. It's rotating just against that 100 level on the RS ratio scale, so that that means that the red RS ratio line is just shaving off the 100 level if you plot it as an indicator on your graphs. And we see that discretionary is picking up, is going through a big momentum move, while communication services is rolling over downward. Now, if we bring that to the left-hand side where we have the weekly RRG, it's a couple of, conflicting things that go the other way. Start with discretionary, which is in terms of RS ratio on the weekly scale, the strongest sector. It's rapidly losing relative momentum, while you can see that it is rapidly picking up again on the daily. So if I combine those two with discretionary far on the right-hand side on the weekly, and it has just gone through a negative rotation or losing momentum rotation on the daily, then I think that this is the strong side. This is picking up strength again. That there's a very good chance, it needs a little bit more time, there's a very good chance that you will see discretionary going into weakening and picking up again when this continuation here on the daily provides enough power for that. Now, the communication services picked up on the daily, which you can see here on the weekly as a hiccup inside that lagging quadrant. But you can also see that communication services here is really an outsider, very far and deep into the lagging quadrant, and it's already starting to lose relative strength on the daily RRG. So if this continues, it gets a new negative impulse from relative rotation on that daily chart, which, well, I mean, I don't think that this will help the weekly tail to pick up more momentum and go up there. So I remain very cautious with communication services. What else do we have? We have two staples and utilities. They're moving really in line with each other, and you can add healthcare to that as well, in the right direction. And if you look here, you can see that healthcare, staples, utilities provided that strength. So this was a very strong rotation for those at least three sectors, and together with real estate. You see that here. But they're losing strength on the daily, but they're still looking really strong on the weekly. So we've got to wait and see whether this strength is just the initial first move of new relative strength, and they will turn back up inside weakening, just like technology is doing. And remind you, technology is already here inside the leading quadrant on the weekly. And if that happens, then this rotation can certainly push staples, utilities, healthcare deep or into the leading quadrant. Now, the interesting thing is that these are very defensive sectors. And so that makes you wonder whether that is a pickup of strength in defensive sectors. What does that mean for the market as a whole? Well, we'll just have to wait and see. Obviously, we went through very strong last month. S&P was up around 4%. So all good there. But we can see in the monthly charts later on that a lot of the strength was coming from the defensive sector. So market's still looking good. Sectors in general still looking good. But a rotation like this makes me alert. It makes me want to monitor what's going on with these defensive sectors, and maybe be a little bit more alert on negative signs for market as a whole because of the strength of these defensive sectors. I'm going to leave it at this for the look back on sectors. We're rapidly going to move to the monthly charts before we start to look at seasonality into the first quarter in January. So for the monthly charts on asset classes, I've made a selection here, and we're going to do it really rapidly because most of them still look pretty strong. So here's SPY, going in that stellar uptrend, and last month we made a new all-time high, a new closing high. So that is still very much on the run. If you look at GOV, that's the broader government treasury bond ETF index. That is caught in that trading range. It looks as if we put in a new higher low, which is pointing to higher prices for bonds, but we still have some room to go before we take out that high. And what I found interesting to see is that when you look at IEF, which is the 7 to 10 year bond, that it actually moved lower. So GOV actually closed higher and IEF closed lower. They're both still, the more or less pattern is more or less the same, and we've got to wait which side it's gonna break. But the result, or the result between 10 and 2 years, is the yield curve. And if you look at chart of yield curve, then you can see that last month really showed a fast flattening of the curve. So when it goes up, it's steepening. When it goes down, it's flattening. And I've looked back. I've got this chart on my screen for a long time. It's in my chart list. And every time it comes from below zero, that's an inverted yield curve, and you start to rise. So just after a dip below, you get a negative market reaction. Most of the times you get some sort of a negative market reaction. Here, obviously, 2000, 2001, we were already in a decline, and then we got the 2002 dip. Here you got 2007, 2008. That's obviously the big crisis here going into 2008. And then we had the last time we were inverted was in 2019, very briefly. And we started rallying, and I was looking for that correction, and I said it in previous shows and in articles. It looks like that big decline here at the start of the pandemic was the decline. But more importantly, a flattening yield curve in general seems to be a positive thing for the market. If you look at the flattening period here, all these years, that meant rising stock prices. Here you see sharp decline. Flattening is during a period of rising stock prices. Here you see a big decline, it's rising stock prices. Here you see decline, it's rising stock prices. So the signal from an inverted curve to the decline in the stock market, I don't think is as strong as you might want to see it. But the fact, but during declines of that 10-2 years, so flattening periods in the curve, in general, I think they are supporting stronger stock prices. And that definitely supports or is shown if you look at the ratio between SPY and IEF, which is still showing that strong uptrend. And let's quickly move to commodities, the monthly charts for commodities. They're bouncing off these important support areas, both of them. But the bigger picture here, I still think, is for commodities to turn around. So somewhere in the next few months, I'm going to be careful here. Let's say in the first half of 2022, I think that both commodity indexes will break above their heavy resistance areas and start this real move in commodities. So for the monthly charts for sectors, we're going to go quickly over all 11 and then take a look at the table with the wrap-up. Communication services still coming off that resistance level, trend still going higher. If you look at consumer discretionary, that had a big move down during the month, but it closed actually relatively high up on the bar. Here also the uptrend fully intact. If you look at consumer staples, I think this is one of the more interesting charts on a monthly scale because you see this big bar up, pushing above its previous high that dated back a couple of months back. So that is definitely a strong move to keep an eye on. It's a defensive sector, mind you. We got energy still doing okay, but in its long-term declining trend. The uptrend here is still intact, but a bigger picture still somewhat negative for energy, but I call this an uptrend because it is on a monthly scale and there is still plenty of room to move higher. If you look at financials, that is didn't do much last month, had a little bit of trouble coming off its highs, nothing super spectacular. Healthcare is another sector that is showing a very interesting development on the monthly chart because look at this big monthly bar pushing above the previous high, closing almost at the top of the range. That's definitely a good sign for the healthcare sector. If you look at industrials, that's still inside that sort of range-bound pattern. And it can go either way. If we move higher, that's obviously good. I'm now at a point where I feel that when the industrial sector drops below, let's say 825, that completes a double top and that would end this uptrend for the materials sector. We're not there yet. We're probably closer to a break to new highs if you look at where we closed at the end of December, 895, but you've got to keep it in mind. Then we have technology, still going strong, no change there, new all-time high, new closing high, so all good. If you look at the materials sector, that is coming out of that sort of trading range. So that double top is sort of out of the question right now. That's negated, and we're now, especially the close in December was above that previous high. That's good. We're now looking for follow through in January and maybe the first quarter of the new year. Real estate, we've already seen the strength in V and Q when we looked at asset classes. That is also reflected in the monthly bar chart for XLRE, or in this case, the real estate sector index. Nice move higher, strong bar, uptrend fully intact. And then finally, another very interesting chart is for utilities, because this is breaking out to new highs. and that latest high dated back to February 2020. So this is one of the sectors that had not made new highs yet, and it's now doing it. So that's a good sign. But also, mind you, just like staples, this is a defensive sector, and that's one of the things that I'm keeping my eye on. All in all, the overall view for sectors in general is still pretty good. And if we wrap all of that information up in the table that you are familiar with now, we can see pretty much overall positive numbers for the month-to-month performances, except for discretionary. We have a number of new all-time highs: staples, healthcare, tech, materials, real estate, utilities, and the same sectors made new closing highs. So that's interesting. The sectors that made new all-time highs also made new closing highs. Quite a few that didn't do that. All of them are in an uptrend. We've looked at the charts. All these uptrends are still there. This is in an absolute way. You know, this is all based on absolute analysis. No relative things at all. You can see the sector weights here and the downside risks as I've established them, looking at the first and second support levels for each sector. A few of them have changed. Overall, you know, within reason, these are the levels that the market needs to come down per sector to actually turn those uptrends maybe into a downtrend or negate the uptrend. That's the difference. When you negate the uptrend, you're not immediately in a downtrend. All in all, it means that 54% of the sectors, that's market cap weight, 54% of the market made new highs, same 54% made new closing highs, and 100% of sectors in the market is in a long-term uptrend. If we look at seasonality for the S&P 500, the market itself, then we can see that it is a mixed bag. 50% of the time the market closed higher, which means that 50% of the time the market closed lower. And the average return over the last 20 years for the month of January was minus 0.2%. So that is really not a lot. So 50-50 and almost a flat return. What does that mean for the sectors and sector rotation? When we look at the table, we see that there are a few sectors that are standing out. So communication services, good in December, continues to be good in January, and then drops off a little bit. Technology, pretty good, wasn't that good in September. It's 65% in January, but then it levels down again, goes to almost 50-50 again. So that is sort of an interesting one. And then you got healthcare at 65%, but that rapidly drops in February and March to 30 and 40%, which means that there is a 70 or 60% possibility of a decline. But healthcare already was very good in December, so there's a risk here. So this looks good, but there's a risk here that we've already seen that seasonal move for healthcare. Now, if we look at the expected returns for and then we've got materials and industrials, both at 40%, 60% odds for underperforming in January. If we look at the expected performance figures, then we see communication services at an expected return of 60 basis points outperformance. So the average outperformance for the last 20 years, 60 basis points for communication services. Technology is flat, 0. So that is not very good. And then healthcare actually had a very healthy 0.9% outperformance over the last 20 years on average. While materials was down 80 bips and industrials was down 50 bips. By the way, this is below the market, but with a market that's flat, that's almost like the absolute return that you can expect for those sectors. We're going to have a quick look at the accompanying rotations. Then we see for materials that it's actually doing pretty well, while the seasonality is not that great. When you look at communication services, that's in lagging. It's picking up a little bit, but the seasonal expectations are pretty good. If you look at industrials, that's coming down, which would imply the same. So that's in line with the market, with the expectation from seasonal point of view. If you look at technology, that's going stable inside the leading quadrant, so that's good, but the expectation is not that great, especially not in terms of the expected returns. And if you look at healthcare, then that's actually going up into the right direction. It's got a good expected return, and it's got high odds on its side for outperformance going forward. And if we wrap that up in a table, then we can see the odds for communication service is pretty good, but the rotation is not that great. It could be a massive outlier. If that picks up and makes a big move, it could be an outlier. Technology is sort of flat. I don't know what to do with that. Healthcare seems to be the best option based on seasonals and the rotational trend. And then we've got materials and industrials. They're both good options on the short side or the underperformance side, where they 60% odds of underperformance with 0.8 and 0.5% downward expected returns. And that concludes the first episode of Sector Spotlight for this year. I hope you enjoyed the show and thank you for watching. The new year, Sector Spotlight continues to air every Tuesday from 10:30 to 11 a.m. Eastern. And I hope to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.